am absolutely glad to be here. And I got to tell you, I'm not only honored to be participating with AAR, but I'm also very honored to be speaking to you, self-employed individuals. I mean, heck, my parents were self-employed. I'm self-employed. So I've always kind of admired anyone who's willing to take a little more risk in order to make a lot more money. So welcome. All right, we're going to be doing a lot today. This is those of you who've been to one of my programs will probably know we do a very content-rich program. This is not a lot of fluff. We have a lot of information here. This one in particular, there's a lot of stuff here we're going to glance through. 10 of the top tax tips that I think realtors and real estate professionals need to know. We're going to glance over each one kind of superficially, but I want to give you the basic tip. And any one of these can be a whole seminar in many cases. But I do want to give you a good overview so that you can then, talk about this with your accountant, do some more research, go to our video vaults and things like this and get more information on it. And we're going to probably have more seminars on these individual tips as well. But I just want to give you a broad overview. But we're also going to be talking about some of the Biden wish list type of things, how you can expect in the near future to change, what things will be coming in. Biden's been pretty much getting what he wants, so I think it's pretty likely a lot of this stuff will come in. So we're going to be focusing on that as well. Okay, let me click on this and see if we can get this moving. Here we go. All right, a little background about me. My name is Sandy Botkin. I'm a former trainer of IRS attorneys nationwide. So if you think of an IRS agent as a rat, I guess that makes me the head rodent. I'm president of the Tax Reduction Institute. Some of you may have been to many of my seminars. I've done seminars for many, many years around the country. I've been a featured tax coach, as Tatiana mentioned, at the Tony Robbins seminars. I'm a best-selling author of a number of books, one of which is Lower Your Taxes Big Time, which I recommend to you. I have another book which I just wrote about a couple of years ago called Achieve Financial Freedom Big Time, which has garnered some terrific reviews. And I've been a guest tax expert on a number of networks. And I'm not saying this to impress you. I just want you to know that I know what I'm talking about, because there are going to be some things I'm going to be saying that may surprise you. So be aware of it. I am aware. I do know what I'm talking about. All right. Before we get started, I want to jump into the 10. First, I want to jump into a couple things that I think, and this is going to be sort of bonus information before we get into the 10 tax tips. And we're going to be spending a few minutes coming into what I think Biden is going to want in 2021. He's president. We have a Democratic-controlled House and Senate, so there's a pretty good likelihood that a lot of this is going to pass. I'm not going to spend a lot of time on this, but I think it's things you should be aware of. And we can expect some tax changes. I mean, some of you may be saying, raising taxes, what horrible. But you know what? With the deficit the way it is and all the stimulus that's coming out, somebody's got to pay for it. Okay, nobody. It's like the giant gorilla in the corner when we look at the deficit. So someone really has to pay for it. So you can expect tax increases. I don't care who the person was, what kind of party it is. But let me give you an idea of what he wants to do. First of all, you generally will not see tax tips if your income is under $400,000 of adjusted gross earnings. That's basically net income from your business. So if you're making over $400,000, you might see an increase. If you're making under that, you probably won't see any increase, which is good for you making under $400,000. If you're making over $400,000, you're going to see a couple differences. One of the things he wants to do is increase the top rate from 37% to 39.6%. So if you're making $500,000 of net income, or $800,000 net income, that's about a 2.6% increase. The biggest increase, however, is not that. The biggest increase is he wants to put a payroll tax that he'll pay for Medicare and some of the Social Security of 12.4% of incomes over $400,000. So please be aware that that is something that's in the works that he wants to do. So you should be aware of that. Some of the good things, by the way, is that things I'm going to be telling you today can reduce your net income, reduce your adjusted gross income below the $400,000 threshold. So this will help on all of these potential tax increases. So be aware of that. Now, another thing he wants to do is to raise the maximum corporate tax rate. Right now, the top corporate tax rate is 21%. He wants to raise that to 28%. That will probably have some effect on the stock market. There may have effects on corporations and things like this. I personally am not in favor of this particular change because corporations can do things that Americans cannot do. They can leave the country and start incorporating elsewhere and not have to do that. So I'm actually against this, but that's here or not. My goal is to give you what the law may be, not whether I agree with it or not. So you should see a 7% increase in corporate tax rates, I think, in the future. Now, some other good news that you'll like is under the tax reform law that was passed 2 years ago, you guys are getting a 20% pass-through deduction. Now, what that means is basically 20% of your net income you can exclude from being taxed on. And Biden is going to keep that. He's not going to change that. It will phase out, however, if your income is over $400,000. So if you're making $400,000 or less, you won't have to worry about it. If you're making over $400,000, then this 20% pass-through will start phasing out. Another bit of bad news is right now dividends give you a maximum rate of capital gains. You get capital gains on dividends, which is a maximum rate of 25%. Biden wants to change this to an ordinary income rate. So whatever the ordinary income rate would be, whether it's 10% or 39%, that will be the way they'll be treating dividends. So be aware of that. A couple other things. Again, you want to make sure you get all the deductions you're entitled to because tax is going to increase. And so getting all the deductions can help reduce that tax bite, and maybe even get you below $400,000. And we're going to be doing much in-depth training on this. So if you're on an email list, you're going to get access to that. So that's good news for you. All right, let me get into, that was kind of like the bonus I'm giving you. Let's get into some of the top 10 deductions for real estate professionals. And I'm going to move very quickly, by the way, folks. I'm really going to move. And my goal today is to show you a bunch of deductions that you should be taking that probably many of you are not taking. And we won't have time to get into every deduction or even to delve deeply into any specific deduction. But I simply want you to be aware of them, which will allow you to work with your accountant to make sure that you're getting them, okay? That's the important point. Okay, now first thing we're going to be talking about is home office deduction. Now, many people believe that taking the home office is going to increase your chance of audit. Did you ever hear that? Well, I got to tell you, if that were the case, then I wouldn't be telling you about to do it. But the good news is that 30 years ago, perhaps that was true, but not anymore. In fact, Congress in 1999 made tax laws easier to claim the home office deduction. So, why would they make it easier if they didn't want you to do it? Not to mention the fact that I have some friends that actually did a study on the home office, and he tried to find out what the chances were of being audited, and he found that the chances were about the same, whether you claim home office or you don't claim home office. So my point is, if the chances are the same, why wouldn't you take it if you're eligible? That's my point. So I do recommend that you do take it. So the truth is that this write-off, this is a very important part about a home office. Some of you may be wondering about whether it's beneficial to you, but this write-off, if properly implemented, could easily save you hundreds of thousands of dollars on your taxes over your lifetime. This is not a small change kind of thing. And most of these 10 things we're going to be talking about today are not chump change. These are all can be big things. Okay. I estimate just an average benefit of a home office can save you between $2,000 and $3,000 every single year. And that's just on an average price home. If you're sitting with a $700,000 home or a $1 million home, you're talking multiple times that. So the home office deduction is a big deal. That's really the bottom line. It's not chump change. Now, there are two methods of claiming a home office, okay? One is called the IRS, and this came in a few years ago, simplified approach, otherwise known as the safe harbor rule. If you hear the word IRS method, it should probably hit you. That's probably not a good deal for you, and that's probably true here. And quite frankly, I do not recommend this simplified approach. It's garbage for a number of reasons. The traditional approach to the home office will save you usually many times that of the IRS method in the long run. So the first thing I want you to remember is that you don't want to use the simplified approach. The IRS method is the bad method. You want to use the traditional method. Now, so what is the traditional method? The traditional method, which is the one I'll be teaching you, you need to do a couple things. The first thing you need to do is to find out your total square feet in your home and the square feet in your home office. Now, how would you do that? Well, you can measure it. The other way you can do it is just get your floor plans and figure out how many square feet are in your home. And most of us know that, actually. and how many square feet are in the particular office that you're working. I mean, that's really not that hard. So let's take an example. Let's say that you use a home office and your home office is 210 square feet. Your total square feet is 1,600. You would take your 1,600, which is your total square feet, divide it into your home office square feet, and that will give you a percentage. That is the percentage of your home that you use for business. Now, armed with this, you can take some pretty amazing deductions. You still have to make sure you qualify to claim the deduction. We're going to teach you how to do that in a minute. But now let's assume you qualify. For an average home, and let me tell you, under the NAR, the average home is probably cheaper than what you're living in. But according to the NAR, an average home of $230,000, that's what they say an average home is in the United States. That probably includes Prudhoe, Iowa, okay? I understand where you're living. That's not what an average home sells for. Believe me, I was visiting a friend in California. I couldn't drive up his driveway for $230,000. I can't drive up my house for $230,000. So I get that, okay? But the average home on $230,000, here's what we get. So I have to use some numbers. Let me see where I want to be here. And by the way, by claiming a home office, I do want to mention a couple things before I get into this. You can deduct a portion. You know, when I say 13.1% of your home is a home office, what does that really mean? That means that 13.1% of the mortgage interest is now business interest on your Schedule C. A lot of times people say, well, I don't own a home, I rent. No problem. 13.1% of the rent becomes business rent and deductible on your Schedule C. 13.1% of your utilities, 13.1% of your home, of lawn service, alarm monitoring, property taxes, home insurance, repairs, lawn care, all these things, okay? And this can be pretty significant. Now, let's see if I have the number here. Okay, before I get into this, I want to know, in order to qualify for the home office, I should mention what are the three tests. I'll give you an overview here. And again, I'm giving you an overview on a lot of these things. You can go over it with your accountant. We can do a whole in-depth thing just on home office, but I just want to give you an overview. The first test, is there any one, first of all, do you use a place regularly for business? So let's start off. In second test is use an exclusive portion for business. And the third test is a principal place of business. We're going to start off with the principal first. We'll take number 3 first. The principal first is your home your principal place of business? In other words, is there any one location where you do all your important functions for your business? Now, as realtors, you do important functions in a lot of different places. You do important functions in your home. You do important functions in a client's home. You do important functions in your realtor broker's office. You do important functions in your car. I can think of at least 4 places where you do important functions. So the chances are you don't do one place where you do important functions. So the next thing, the next part of that test is, okay, if you don't have one place where you do important functions, and again, I'm focusing on number 3 right now, do you have more than one location where you do important functions? Which in most cases is true, you do. If so, then here's the test. Do you spend more than 50% of your working time working from home? 50%. Now, in many realtors' case, that's probably not the case. So you probably don't meet either of these tests, because if you add the time you spend in a client's home, the time you spend at home, the time you spend in your car, the time you spend in your broker's office, I'll bet you don't spend more than 50% of your working hours at home. So that leads us to the third situation, okay? So you may not pass these first 2 tests. So there's a third test. Let's see if I can get into it. I don't think we listed here. The third test is, do you do your administrative functions from your home? Now, that's very different than sales function. Sales is okay from your office, and you want to do administrative from your home. Now, what's the difference? Administrative is things like cold calling, cold mailing, studying for the GRI program. Administrative is setting up appointments. Sales is seeing clients. Sales is cold calling. Sales is phone duty. You can do your sales function from your broker's office as long as you do your administrative function from your home. If you do most of your administrative functions from your home, you meet test 3. Now, in addition to that, you've got to use a home regularly for business. Now, when I say regularly, I mean at least 45 minutes a day, 4 to 5 days a week. And finally, it has to be an exclusive portion of a room. It doesn't have to be a whole room. It could be a part of a room, but an exclusive part of a room. So get those cookbooks out of the bookshelf where the home office is. Get those bridge books out of the bookshelf. When they say exclusive, they're not kidding. So that's basically an overview of what you need to have a home office. Unfortunately, we don't have more time to do this, but we will be getting an entire seminar on more in depth on this. Okay. Now, the next topic I want to talk about is vehicles. There's no question. Vehicles, if you understand what's going on, can save you hundreds of thousands of dollars over your lifetime. And that's particularly true under the tax reform law. It's just tremendously. If you do this correctly, you can make a fortune understanding this. The problem is most accountants simply take down your total mileage that you report and give you a fraction of what you deserve. Now, let's put this on mute if we can, everybody. Now, there are two methods of keeping track of your vehicle expenses. One is the IRS method. Remember what I said? If it says IRS, it's probably not a good deal. IRS gives you 56 cents a mile this year. I'm giving you this year's rates for every business mile you drive for business. Okay? By the way, who determines how many miles we drive for business? Does the IRS or do we? And the answer is we do. And how do we do it? We have to have a good tracker that I'll get into. Okay? The better approach, however, is to use the actual method, not the IRS, but the actual. Now, what is the actual? This is where you would keep a track of your mileage, for expenses for business, your gas, your oil, your repairs, your insurance. The IRS method, you don't have to keep track of all that. You get a flat 56 cents a mile. But the actual actually produces more. And what's interesting, and here's the important point, is that both methods require you to document your business mileage. The actual documentation, the tracker that you need, is the same whether you use the IRS or the actual. If the actual is better and you got to have the same documentation, heck, why not do it? It makes sense to me. Okay? And here's another little tip for you that a lot of people miss. Whenever possible, turn your personal trips into business trips. You'd like to know how? I'm going to give you a tip that a lot of us accountants and tax lawyers use, and I think you should be aware of this. Let's say you want to drive across town to visit your mom or dad. Now, normally that's not deductible. You want to take your kids to a football game, not deductible, or to tutoring lessons, not deductible. However, with a little planning and some creativity, you can set up a meeting with a client or a prospect that is near your mom's house or near where you take your kids tutoring. Now you have a legitimate business reason that puts you in the neighborhood. So you do some real business, document it, and you now turned a personal trip into a business trip. And as a bonus, you get more work done too. And this is a way of converting personal mileage to business mileage. If you do this, by the way, say hi to your mom. Okay? Now, let's do another interesting things about being a business. You have access to a tremendous amount of tools, which, let's face it, you have software, MLS access, signs and posts, marketing materials, key boxes, cell phones, association dues, computer, and all this stuff. Basically, anything that you do in your business that helps you in your business, you can write off immediately. You don't need to generally depreciate a lot of this. You can write this off immediately. And the way you write it off is a section of the Internal Revenue Code called Section 179 that allows you to write off up to $1 million of equipment. So please be aware of that, okay? And this is something that's really, really good. Now, let's talk about something that I really want to get to. It's a really, really big item. And again, all of these, I want to emphasize again, for those who came in late, I'm giving you an overview, things you can talk with your accountant about. I can do an entire seminar in any one of these topics, and I will. But I'm giving you a good overview here, all right? But one of the things I want to talk about, which is very important, is about medical expenses and medical insurance as well, which is one of my favorites. First of all, medical insurance is deductible by self-employed individuals. It's limited to your net income, but it is deductible. It's a business deduction, so be aware of that. And that also includes long-term care insurance like nursing care, things like that. But what about other expenses? I mean, let's face it, we get a lot of medical stuff, such as things like deductibles and eyeglasses and co-insurance and things like that, and pre-existing conditions and drugs and stuff like that. How do we write those off? Well, a lot of people have heard that, and in fact, I was just watching on the news today, you got to exceed a certain threshold. They were talking about how they reduced the threshold to 7.5% of the adjusted gross earnings. So if you make $100,000 a year of net income, you got to have medical expenses of over $7,500, 7.5%. And that's what a lot of the things they're saying on the news. The sad part is the savvy business owners aren't doing that. The savvy business owners have a way of getting around the threshold. How would you like to be able to deduct all your medical, all your dental for you and your family with no threshold? Would you like that? You can do it. And the savvy business owners are doing it. And it's the way you do it is with a self-insured medical reimbursement plan. It's got another name. It's called a health reimbursement arrangement, HRA, health reimbursement arrangement. Now, many of you may have heard of a health savings account, which is kind of like a savings account, which is pretty good. But I'm guessing you probably have never heard of a health reimbursement arrangement. So what is a health reimbursement arrangement? This has no contribution, unlike the health savings account. Instead, as you incur expenses that are not covered by insurance, you actually pay these expenses for your family and for you. And the point is you get to deduct 100% as a medical expense, but not as medical, as a business expense. Now, many times these savvy business owners will set these things up. So it allows you to write off all of these things, from copays to prescription drugs to office visits to out-of-pocket expenses to the mileage to the chiropractor and so on, as business expenses, not medical, business expenses. So you avoid that 7.5% threshold. Now, how do you make this happen? To make this happen, you want to hire your spouse to do legitimate work in your business. Now, essentially, you have to cover your employee spouses. If you have health insurance, you want to have health. This is not replacing your health insurance. This is in addition to your health insurance. This is covering the things the policy doesn't cover, okay? So you put this HRA in place, this health reimbursement account in place as a fringe benefit by allowing the business, being you, to reimburse family members and their dependents, which means you again, for medical expenses that are not covered by insurance. So this covers you and the family, okay? And so you're covering your spouse, you're covering all dependents, which means you and the kids. This also includes kids, by the way. Your dependent kids, so you get to write off the entire thing. What's interesting is this has been in the tax code for over 60 years. So if you haven't known about it, you have been overpaying your taxes a long, long time. So what does the HRA cover? Give you an idea. It can cover copays, deductibles, medical supplies, eyeglasses, contact lenses, braces. I use this to write off $12,000 of braces for my family members, prescription drugs, and a lot more. A key, it needs to be legitimate hiring. You need to hire your spouse for this to work, but it's not expensive to put in. You need someone to administer it for you. You should have an administrator for you. It's not expensive, as I mentioned, and using an administrator makes it very, very easy to do. In fact, let me get to where I want to be here. There's a special firm that does a lot of the administration for me. It's a firm called TASC, T-A-S-C. You can find out more about it by calling our office, and you can get to HR. The way you can find out more about it is go to hra.taxbot.com. That's hra.taxbot.com. We'll give you the information on fiduciaries and how to apply for it. They actually give you a debit card. They set you up with it. They'll draft it for you. All you do is use your debit card, and now you write off the whole thing. I mean, it's really a simple thing to do, but it's well worth it. So you go to tax, you'll see it right here, taxbot.com. I think I had it wrong, /HRA. That taxbot.com /HRA. There's a questionnaire. It'll show you if you qualify, which you probably do. It'll show you fiduciaries that you can apply for. They'll give you a debit card. They'll set it up for you. It's really easy to do, really cheap. It will save you tens of thousands of dollars. I mean, I write off over $12,000 of braces alone from this. So taxbot.com /HRA. That's how you do it, okay? Something very important you need to know. Make sure you can write that down, that you have that link, okay? All right, another big change. As a result of the latest stimulus bill that was passed in Congress, they brought in something called the 3-martini lunch. Now, what is that? Well, let me explain. Prior to the stimulus bill, you were able to write off 50% of all meals you have with prospects. So if you take a prospect out, you can write off 50% of your food costs for them and 50% of your food costs for you. Well, as a result of the stimulus bill, they now allow you to write off 100% of the meals for all prospects. So now when you take out a prospect, you get a 100% deduction through 2022. There's a catch, and this was put in to entice businesses to spend money on meals at struggling restaurants. So the catch is you have to buy your meal from the restaurant. Now, what's interesting is you don't have to eat it at the restaurant. You just have to buy it at the restaurant. So if you want to get an Instacart delivery from a restaurant, feel free. You want to take it out at the restaurant and go eat it at your house or go eat it at the park, feel free. All they care about is you bought it at the restaurant. And this is IRS's and Congress's attempt to help restaurateurs. So as long as you buy it from the restaurant and not Whole Foods, you get a 100% deduction if you talk about it with prospects and you have a meal with a prospect. If you buy it at Whole Foods or at Publix or Vons or one of these others, you get a 50% deduction. Buy it at a restaurant, you get a 100% deduction. Real simple. Now, here's the question. How would IRS know you bought food from a restaurant? The answer is very simple. You keep the receipt. That's simple. Show it came from a restaurant. So this nice 3-martini rule is back. And this is going to be back through 2022. So be aware of that. You get a nice 100% deduction for meals with prospects, and the government is now subsidizing you instead of 50%. Now, with business meals, there are some specific rules you need to be aware of. You know, the government doesn't want to just let you write off all your meals, every one you have with everyone, and not have to account for anything. I mean, otherwise we'd all be, we wouldn't pay any taxes. All we do is eat our way through our taxes, and that'll be it. So there are certain rules you need to be aware of. They're not hard, but you need to be aware of it. First thing you need to be aware of is you want to make sure that your accounting for business meals is separate from entertainment, because entertainment under the tax reform law was disallowed. So if it's a combination of a meal plus a show, and you have to pay extra for the show, you can deduct the meal portion. So you want it separated. Secondly, the food or beverage must be provided by a restaurant. I said this before, but I want to emphasize this. Now, as I said, they're used to the word by rather than in the restaurant. If you want to eat at the restaurant, that's okay, but it's got to be by a restaurant. So if you want to take out or have delivered meals, that's perfectly fine. Number 3, the expense is ordinary and necessary to your business. In other words, you're using it to entertain a prospect or employees or something like this. Number 4, the expense is not lavish or extravagant. To be honest with you, I've seen people do all kinds of crazy stuff. I have never seen one tax court case saying it's too lavish. If you want to get a whole bottle of wine, you want to get 2 bottles of wine and a couple of bottles of liquor, hey, go for it. Because I've never seen them say it's too lavish or extravagant. So this includes liquor, too, by the way. Number 5, you or your employee has to be present when the food is provided. So somewhere you can't just give them the food, you got to be there, or your employee has to be there. Okay? And finally, the food and beverage provided to either a current or a potential customer or client or consultant or similar business contact. So you got to do this to try and make money. Okay? Now, by doing this, you'll be able to write off 100% of the cost of the meal. Again, meals provided by restaurants are 100% deductible. Meals provided by other places like a supermarket are 50%. So I want to emphasize this. Okay? Now, in addition, see if we have this. Here we go. Good. You have to document that certain things called the 5 W's and an H in your tracker, such as TaxBot. So what do you want to show? You want to show who you met with. In this case, Sandy Botkin, Nancy Zeldin. Who did you meet with? Number 2, what type of expense was it? Was it a breakfast, lunch, dinner, snack? What was it? Okay. Number 3, where did the expense occur? What was the vendor? In other words, I went to Outback Steakhouse. I ate it at home. I went to Greasy Lloyd's. Where did you go? Number 4, when did the expense take place? In other words, what was the date? Number 5, why? What was the business purpose for the meal? Now, I want to emphasize something here. Be specific. It is much better to write down things like ask for real estate referrals than say referrals. The more specific, the better. Be specific. So we have who, what type of expense, breakfast, lunch, dinner, snack, where did the expense take place, when, and why. And finally, how much? $28.99, for example. How much? Please choose not to apply, don't make everything even numbers. Put the exact amount, okay? If you do this, you will never have to worry about an IRS audit again. Now, how do you do it? In your tax tracker, which I'll get into, okay? So, some other examples. When I say specific reason, I'm not kidding. Met with a former or existing client to finalize a contract is specific. Meet with potential suppliers. Ask for referrals, including friends and family, okay? So you want to be specific. The more specific, the better. I don't know if any of you have seen some, like NCIS and some of these criminal shows. One of the first things the policeman asks is, what's your alibi? If you have a good alibi, what happens? They move on to the next person. But if you don't have a good alibi, if you said, I just simply went to the movies, you think they're going to believe you? No way. But if you simply said, hey, I went to the 9/10 showing of Guardians of the Galaxy 2 at the Rio, that's a specific alibi. The more specific, the better. I can't emphasize that enough. The more specific, the better. Okay? So keep that in mind when you do your documentation. All right. We talked about a number of things. What else? A lot of times I get asked questions, can we deduct classes and courses? And how about college courses and things like that? Honestly, the answer is very situational. Let me explain the rule for you about classes. The general rule is that in order to deduct a class, in order for it to be deductible, it must either maintain or improve. That's the key words, maintain or improve the skills required by your present trade or business or job, or it must meet the express requirements of an employer, or it must meet the express requirements in order to retain your salary, such as continuing education. So continuing education, express requirements of employer, or maintain or improve your job. Any of those three, and you're in good shape. But this can be a little bit misleading. There are some exceptions to this rule. Nothing's easy in tax law. There's always an exception, all right? The education will not be deductible if it meets the minimum education requirements for qualification in a new trade or business, or a part of a program and study that qualifies you for a new trade or business. So let's take an example. If you're simply taking courses on sales and marketing in your real estate business, that's deductible. You take a course in continuing education, that's deductible. Tax training, deductible. Contract negotiations, deductible. On the other hand, business coaching is deductible. On the other hand, if you go to law school, even though you may be taking some business coaching in that law school class, that won't be deductible, but that qualifies you for a new trade or business. That's a good example, okay? But if you simply take it as part of your continuing education or part of your improvements as a realtor, no problem. Okay, and all of these things, sales training, all of these things are deductible as a realtor as long as it doesn't qualify you for a new trade or business. That's the key. All right. Big thing that's overlooked. A lot of times people ask me, can I deduct my kids' college education? The answer is no. Can I deduct their wedding? No. How about room and board for that they're spending on college? Is that deductible? No. How about if I pay for their car? Is that deductible? No. At that point, they're getting kind of frustrated. What if I were to say to you that you can write off the equivalent of every single thing I just mentioned if blessed by the government? You like that? I bet you that'll knock you off your chair. Here's how to do it. Again, this I know there's a lot. I'm covering a lot, by the way. You will get a copy of the audio of this, and you can implement this with your accountant. You can attend some of our more in-depth seminars. You get my book. There's a lot of ways to get more depth on this, but I did want to give you an overview on this. Instead of paying for all this stuff, which a lot of the people who don't know the rules do, hire your kids in your business. Let me ask you a question. If you were to hire your kids in your business and pay them a reasonable wage, if you hire any assistant in your business, are that deductible? Yeah. And if they use that money to pay for their own college, their own wedding, their own room and board down the road, their own car, their own video games, aren't you in essence getting a deduction for those things? It's the same money. But in one case, they went from non-deductible wages to deductible tuition, or in this case, deductible, I guess a VR game, virtual reality game over here. Okay? It's the same money. Let me give you an example. My daughter majored in digital design, which is kind of like web design and animation and things like this. She was a junior, just started her junior year, and I wanted to get a whole website for my business. And the website included all kinds of things. You can get a website, but if you want to get a good one, it's going to cost you a lot of money. I wanted to get all kinds of special, analysis and a bunch of other stuff from my website. So I went to a firm that does this, and they gave me this huge quote. So I said to my daughter, I said, can you prepare my website with the things that I want? And she said, yes. So I was able to pay her something less than what the other firm would have charged. That made it reasonable. A reasonable wage is what you pay someone that's less than what an outside firm would charge you, okay? The amount I was able to pay her covered over 2 years of her college tuition. She went to a state school, so it wasn't that expensive, but over 2 years of college tuition, plus her books, plus most of her room and board. So in effect, I got a deduction for I was able to pay her for the website. She got that money, and she was able to use that to pay for her tuition and most of her room and board. So effectively, I got the deduction for the equivalent of tuition and room and board that way. And if you haven't been doing it, you have been overpaying your taxes. This is costing you thousands and thousands away. It's a slick way to pay for your kids' college education, weddings, hobbies, and deduct it. Okay? It's a very, very important thing. I've used this throughout my life. And my parents used it when they hired me in their business. I mean, it just shifted all kinds of money. You look on TV, you see some of these people hiring their kids. This is the reason. Let's face it, kids are expensive, okay? There are piano lessons, there's soccer, there's soccer uniforms, there's video games, college funds, particularly, and the list goes on and on. These expenses can add up very quickly. And this is a way for you to deduct the equivalent of these expenses. Now, if you hire your kids, they have to do legitimate work for you in business, okay? If you pay them a reasonable wage, they can use that income to pay for their own expenses. It's the exact same money. So it just went from being non-deductible to deductible. Did you see that? Now, as I mentioned, there's a couple of hoops. Let's face it, when you hire relatives, if you hire me, IRS couldn't care less. When you hire relatives, you got to dot your I's and cross your T's. So there's a couple of hoops that IRS wants you to jump through. So number one, you need to have an official timesheet showing what your kids did and how hard they worked. You want to make sure you pay them a reasonable wage, which means something less than what an outside person or an outside agency would charge. Okay? Then they can use that wage for any reason. They can use it to pay for their own piano lesson. They can use it to pay for their sporting activities. They can use it to pay for their uniforms. It's a win-win situation. Everybody wins except the IRS. It's wonderful. Now, another option you can use is to hire your spouse to do legitimate work. And one of the biggest benefits to hiring your spouse is that you can have a health care fringe benefit. Like you can set up that self-insured medical reimbursement plan, hire your spouse, and they elect family coverage, which means they cover you. And now you can deduct all the medical and dental expenses for you and your whole family by doing this. It's a great thing. So again, keep this in mind, a real big thing. Now, another big thing I want to mention is entities. I get this all the time. What kind of entity would you recommend, Sandy, if as a realtor? I normally recommend when you start off your business that you start off as a self-employed individual. One, because it's easy to do, and you get a lot of these benefits that I'm mentioning as a self-employed person. It's simple, 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 okay? Now, once you achieve a certain level of income, once you start approaching, I would say $200,000-$300,000, then you might want to consider an S corporation. Now, why an S corporation? An S corporation eliminates. First of all, there's a couple benefits of an S corporation. You can have part salary, part income. The salary, the income portion, the distribution is a dividend, which is exempt from Social Security. So one benefit of an S corporation, you can save FICA taxes. Second benefit, you can hire yourself and pay yourself a wage. And as you're making over $157,500 as a single person, or over $315,000 as a married person, you will find that having wages is very important because it will allow you to benefit from the pass-through deduction. When you start making over a certain income, you have to have a certain wages in order to benefit from that 20% pass-through deduction I mentioned at the beginning of the program. So you'll need wages in order to do that. An S corporation will allow you to do that. So effectively, if you're making over $157,500 as a net, as a single individual, net, that's net of all your expenses, or over $315,000 married net, you might want to consider an S corporation. Otherwise, you can be a self-employed individual. All right. So keep that in mind. There's more to it than this. As I said, I could spend a whole day on entities, but it's kind of an overview. Retirement programs. There's a lot of retirement programs that realtors can set up. That's one of the greatest things. And you can set up a program that makes any government plan look small by comparison. There's no question you should be putting money into a retirement plan. A lot of times people think, well, I'm very young. I'm only just started the real estate business. Why should I worry about this? Yeah, you should. Believe me when I tell you, retirement comes quickly. I can attest to that. I really can. It really does. Also, what's very interesting is that the earlier you start funding your retirement, the greater your retirement will be geometrically. You'd be surprised. An extra 1 or 2 years of savings makes huge difference in retirement. And whether you believe taxes are going up or not, there's a lot of different ideas that in retirement options out there that a lot of people don't know about. Most people know about a few of the options, like a regular IRA or a SEP, but they don't look at a lot of other things. And when you're a business owner, you got a lot of options that a lot of people aren't looking at. Some of these are tax advantaged, which means you pay very little tax on it. Some are tax deferred, which means you just don't pay taxes now. But you get a deduction now, that's the bottom line, or you pay for it later, which depends on your financial situation. You're going to need to meet with a financial planner about any of these things who specializes in this stuff to see what works best for you. Each of these has income and eligibility requirements that you have to meet. So it's important to know that you do have options on these type of things. For example, you can set up if you're making a lot of money, let's say you're a really successful realtor, you can set up as much, you can put away as much as $230,000 a year. Yeah, you heard me right. In a special kind of plan. One of the things you might want to set up instead of a deductible plan is a non-deductible plan, something called a Roth IRA. Now, why would you ever want a non-deductible plan where you can set one up deductibly? Because when the money comes out, it is tax-free for the rest of your life. That's why. And I got to tell you something, with the deficit that we are incurring, you heard it from Sandy Botkin, you're going to see taxes go up. I don't care what the party, whether it's Republican or Democrats, taxes are going to have to go up. There is no such thing as a free lunch. You hear about all this stimulus. Somebody's got to pay for it, folks. So having it tax-free at retirement can be a big, big deal. And you want to meet with a good retirement planner. And you see it, by the way, a really good chart here you might want to use with them. Okay? All right. We talked about some of the top deductions for real estate professionals. But I do want to mention that one of the things you want to do is meet with your accountant as well as your financial planner. And you want to meet with them regularly. Now, there's a very important point that I want to talk about here. Most accountants do anywhere between 200 and 400 tax returns. The problem is they don't really start doing tax returns probably until, I would say, the mid-February, end of February, because your 1099s didn't come in till then. Yet the tax return is due on April 15th. Now you think about that. You divide that by the 200 to 400 tax returns, assuming that they do about 7 returns a day. They only have about 2 hours to do a tax return. That's not a lot of time, folks. That's the problem. And many people want to ask their accountant tax questions when they're giving them the return. The problem is they don't have the time to do the tax return. The system is kind of geared against you and them. Okay? So simply being aware of these deductions is very, very important. The best time to talk to your accountant about tax planning is not during tax season. It's after or before tax season. I wish you all learned that. If there's one thing you learn I hope you learned that. That's the one thing that we accountants don't want to be able to do is answer tax questions. We don't have the time, okay? Now, I do want to also mention that these 10 tips that I gave you is the tip of the iceberg. And I know we covered a lot today, but believe me when I tell you, there's a lot more. This is maybe 1/4 of 1% of what's available to you. So I'm going to tell you about something that we put together to make sure you're getting the maximum deductions you're entitled to. First of all, but in summary, certain things I want you to remember. Taxes are likely to go up, particularly with these stimulus. And believe me, this isn't the last stimulus they're going to have. It's going to go up in 2021. It's going to go up regardless of a professional of political power. I don't care if it's Republicans or Democrats. It's going to go up. It's more important than ever to make sure that you get every tax deduction you're legally entitled to. We've shown you 10 ways that professionals can save on their taxes, which we barely scratch the surface of the possibilities, believe me. If you're serious about saving as much money as possible on your taxes, I'm going to show you some secrets to paying less in taxes for the rest of your life. Would you like that? First of all, 3 secrets to paying less in taxes. Let's make it nice and easy. Number 1, keep good records, which means keep a good mileage log, receipts, and expenses. A lot of times people ask me, Sandy, what do I need to do to bulletproof my records? Here's your answer. Have a good tax tracker. It keeps track of your expenses and your mileage. Can't emphasize that enough. A lot of time people say, well, IRS really believe everything in my tracker? Yep. By regulation, they have to believe it unless they can show fraud. So have a good tax tracker. Number 2, get the right accountant. Now, what's the right accountant? You want someone who understands self-employed taxes. A lot of accountants out there. Not everybody necessarily understands it. You want someone who specializes. I usually recommend either a CPA, tax attorney, or a former IRS attorney or IRS agent. Number 3, you need to learn how to play the tax game like the wealthy. Let me give you a good analogy. You probably all learned how to play tic-tac-toe. When you first learned, who won? The answer is the person who taught you how to play. But once you know how to play tic-tac-toe, what happens? It's a tie. If you know how to play, it's an even game. Same thing is true with the tax game. You need to know how to play it like the wealthy. Very, very important. So let's go over each one of those steps. Number 1, you want to keep good records, which means a mileage log, receipts, and expenses. Now, the problem is most mileage and expense trackers are not IRS compliant. So I see a lot of them, they were advertising on TV. Most of them are garbage because they're not compliant. They're just accounting software. In an audit, the IRS is going to want proof, which means receipts, mileage logs that went into creating the financials, not just the financials. They want to have proof. What's interesting is that IRS wins almost 9 out of 10 audits because people don't have the backup data. That's such a sad fact, but it's true. What's interesting, some of you may have heard of TaxBot. TaxBot was developed with compliance as its keystone. You'll find that TaxBot's got everything you want. I'll get into that a little bit further, but it really is quite good. Now, step 2, get the right accountant. They've got to understand self-employed taxes. You got 50, it's interesting. There was a study done, which is interesting. You can probably find it on the web if you Google it. IRS did a study where they gave 50 accountants a set of facts. Guess what? All 50 accountants came to 50 different rules. It was unbelievable. Talk about variance, and they varied by as much as $10,000 on the same set of facts. To get the most out of your CPA, you want to meet with them outside of the tax season. I can't say that enough times. Step 3, you want to learn how to play the tax game. What does that mean? The rich pay less in taxes. It is the way it is, but they don't pay less because they're rich. They pay less because they have a full-time staff to hunt for ways to save throughout the year. They always have somebody looking how to save tax. You go to any major corporation, they got whole departments looking how to save taxes. Now, remember, as I said, your CPA only has about 2 hours during filing season to do your tax return. In my 35 years in the tax industry, I found that the number one thing I can do to help people save money on taxes is to show them tax strategies that are possible. not just do the tax return, but show them tax strategies. And we've created a way to do this very inexpensively. In the past, it's been very expensive. But we found a way to do it inexpensively. And I want to tell you about a mentorship program that we created where folks can hone their tax strategies all year long. And believe me, this is an all-year process. And I want you to remember, somebody once said this, and it's true, the best defense is a good offense. And believe me, that is true. The program that we developed is called the TaxBot Midas Initiative. You can research it. We have a lot of people who love this thing. It's designed with a goal to save you an extra, get this, $10,000 on your taxes this year, next year, and every year after that. 10,000, not a bad goal. Just imagine what you can do if you had access to our private membership group that's designed to save you $10,000. It is the ultimate insider's access. And I want to give you an idea of what the program looks like. At TaxBot Midas, you're invited to a live monthly financial workshop, sort of like this. But instead of giving an overview like we're doing now, we pick an important tax topic and we do an in-depth dive to teach you, and I promise, everything you need to know about that subject. So you'll get a whole subject, for example, on home office. Everything you need. Nothing is left uncovered. My personally, and many, or one of our experts who speak on this, will give you all the information that you need to know to make the most out of the tax deductions that are available to you. Now, just as an example, we recently did a full hour workshop on advanced strategies of hiring your kids. Just did one on that. And one hiring your spouses. We went way beyond what we talked about today, and we really dug deeply into how the wealthy use this strategy to lower their taxes. So we do a monthly workshop, and then at the end of each live workshop, okay, we also give you an hour for live question and answer. So you can get your questions answered. And you can ask me, which is usually I'm the person, or you can ask the guest presenter all of your tax questions and get an immediate answer. I got to tell you that I found many times you'll learn more on these group question answer sessions because other business owners will ask very insightful questions that you may not have even thought of. These things, many times, these have educated me. So it's really, these Q&A sessions are really, really important. And this can last up to an hour. Now, in addition, after each workshop, this is something that's very important, you get an optional free one-on-one 15-minute call with a TaxBot certified professional to answer any last-minute questions that you might have about this month's subject matter. So you actually get a CPA or accountant to answer your questions about anything we've covered on this program or on the webinar. So if your question didn't get answered in the group Q&A question area, no problem. Or you can speak with our TaxBot certified professional. Or if you have a personal or complicated situation, you can jump on the phone and get your question answered. Okay? Now, in addition, you get an online access. This is very important to our Midas Vault. Now, what is this? In this vault, you can maintain lifetime access to all of the recordings that happened during the time that you were a member of our community. So if you join with an annual membership, you can, this is something that's even better, you can unlock all the past recordings during the entire program forever. You get that unlock. Now, you'll get access to our private Facebook group where you can ask your tax question to our TaxBot certified professional anytime you want. And by the way, when you get on our private online, we troll it. We're constantly looking to see questions which we answer. I answer it all the time, or our TaxBot certified professionals answer it. Okay, we've got loads of testimonials. I got to tell you, you can go on, you can see thousands of these things. One person said they never hit a speaker as knowledgeable from our program. One person said we made a scary topic understandable, but also fun. They can't wait to do their taxes this year. I mean, we had one person who said they saved at least $25,000 as a result of just one idea that we gave on the online program. We had one person who was audited who used TaxBot and said they submitted the documents. You can submit it by email or by memory stick, and the IRS agent looked at it, and after an hour, that ended the audit. They were really impressed with the organization. I mean, we've got thousands and thousands of testimonials. Plus, for sticking around to the end, I'm going to throw in, but if you get into TaxBot Midas program, we're going to give you our mileage and expense tracking program free. It's all included when you become a member of our Midas program. And this app makes it a breeze to track your expenses so that you can reduce your tax bill and bulletproof you from even the smartest IRS auditor. How will that feel? And it's a really interesting app. Now, whether you're in the TaxBot Midas program is a fit for you or not, you should definitely get TaxBot, at least get TaxBot alone. It is the most compliant mileage and expense tracker out there. It's integrated with a camera, so it will store all your expenses. It even turns itself on, so you don't even have to remember to turn itself on. And if you want to start getting aggressive on your taxes, you really need to be buttoned up. You know, remember I talked about the fact that IRS wins over 90% of the audits last year, and that's primarily because people just had an accounting system that didn't stand up to the IRS requirements. Really stupid. You can watch a demo of the app on the website that I'll give you in a second and see how it works. But basically, it automatically tracks your mileage for you. It even turns itself on for you. But unlike most of the other maps out there on the market, it's actually compliant, 100% compliant. And it's super easy to use, and it comes with a guarantee. And not only that, but it will track your expenses. So it's not just a mileage tracker. It also tracks your expenses and receipts. In fact, we have a patent. It takes your receipts and matches it to your expenses and fills in the compliance for you. So it'll read the expense, like you get an email receipt or you take a picture of it, it'll actually read it for you. It's an absolute no-brainer. But it's also included free in our TaxBot Midas program. So just to review what you'll get when you sign up for our Midas program. You get the ultimate insider access to my private membership group. Number two, you get new live training sessions each month going in depth on a different money-saving topic. And by the way, we not just cover taxes, we also show you how to make money. For example, we just brought somebody on a few months ago on Facebook marketing, social media marketing. We did several programs on that as a bonus, who was a national expert on that. So you learn how to make money too. Number three, we give a Q&A session with former IRS tax attorney, me. So you get that as well. Number four, you get one-on-one consultation with a TaxBot certified professional. Number five, you get access to my private Facebook group where other TaxBot Midas members hang out and talk shop. And as a bonus, you get our TaxBot mileage and expense tracking app free, which is normally alone. In fact, the app itself is $100. The whole thing has a $5,210 value. If you would go to your accountant to do this, that's what he would charge you. But because we've streamlined the program and mixed group education with a personal touch, you can do it for only $97 a month. And I got to tell you, almost every single one of our customers finds at least $10,000 in cash savings each and every year. I'm not exaggerating. And by the way, because of our relationship with the AAR, we're going to let you try the program for 60 days for $1. Just try it. You can't beat that, okay? After 60 days, then it's $97 a month. If you want, you can cancel it, but almost everybody keeps it. If it puts $10,000 in your pocket, gee, what a saving. What's that, 1,000% rate of return? So not only that, after you enroll, you'll save even more money because if you do it for the year, you get it for $50 if you want to do it for the whole year. So you save half as it is. And you can cancel any time if you feel like you're not getting your money's worth. No questions asked. So it comes with an insurance policy. You know, now is the time to start playing offense instead of defense. The investment is a no-brainer. I mean, you can try it out for $1 for anyone who's self-employed or owns a business, even if it's a side business. But if you want to become a member at this incredible price, you need to hurry because it only lasts for so long because it conflicts with our normal pricing. I'm only making this deal available for 24 hours for people who attend this webinar. After that, the price is $149 a month, by the way, which is our normal price, which, by the way, is still a steal. You can save $10,000 a year. But if you're ready to stop donating the extra money to the IRS each and every year, give the program a shot. You've got nothing to lose and potentially save tens of thousands of dollars of deductions and dollars to earn. and it's only $1 to try it. You can't beat it. Okay? To take advantage of it, go to taxbot.com. You can click on the link or go to taxbot.com/AAR. That's taxbot.com/AAR. And you can get the whole program if you want for a whole year for half price, which is which is about $50 a month. And it's not even $50 a month, by the way, because it's tax deductible. So after taxes, it probably costs you $35 a month if you do it for the whole year. So, I mean, to save $10,000, this is the steal of the century. But if you find you don't want it, you want to just use TaxBot alone, you can also get that as well. But again, go to taxbot.com/AAR. Hopefully, I've convinced you of the horrible mistake of overpaying your taxes. And I certainly apologize to anybody who doesn't get this, because you're going to pay a lot more than those that do. I'll tell you that right now. All right, let me do this. Let's see how much time we have. Oh boy, I finished right on the button. How's that? Okay, let me turn this back to the host. Hi, are you around?
Yes, I am. Do you have time for a few questions?
I'll be glad to take a few questions. Let me take a few.
All right. Let me find. We had a few questions regarding hiring your children. It says, how old do the kids have to be to hire them?
Great question. Believe it or not, there's a case on it. There's no set age. So first of all, I mean, there is no set age, but there is a case that allowed hiring a kid as young as age 7. As long as they do legitimate work, they could be as young as age 7. Now, could they be less than 7? Yes, but there's no case on it. We don't know. But there is a case that allows them as young as age 7. Now, they could be as old as you want, but if there's at least age 7, you should have no problem, as long as they're doing legitimate work.
Okay, piggybacking off that, says, aren't the kids going to have to pay taxes on this money?
The answer is yes, but if they're under 18, they are exempt from Social Security and exempt from federal unemployment tax. No FICA if they're under 18. They are taxed for income tax purposes, but they get a standard deduction against wages under the new tax law of $12,400. So effectively, the first $12,400 they earn is income tax free, and you get a deduction for the whole thing. And anything above $12,400 is taxed at the 10% rate. So it won't be a bad deal for them. So yes, you get a deduction of your tax bracket. The first $12,400 they get is tax free, and anything above that is only taxed at 10%. So it's still a win-win.
Says, for education, does it need to be an instructor-led course program, or would a book on the topic suffice?
Nobody ever asked me that question. That's a good question. The answer is it could be any course you want. It could be an instructor-led course. It could be an online course. It can be anything. As long as it's related to your business and doesn't qualify for a new trade or business, you get a deduction for it.
Okay, let's see. It says, if my health insurance is provided by my husband's employer at a monthly cost of $700, is that able to be deducted since I'm self-employed?
Yes. The answer is, even though it comes out of your husband's employer, you can deduct it as long as you're paying 100% of the cost. If the insurance is subsidized, then it's got to exceed that threshold, or you got to use the self-insured medical reimbursement plan. But if it's not threshold, if it's not subsidized, you get a 100% deduction for the whole thing. So the key is whether it's subsidized or not. If it's not subsidized, then you want to use the HRA to deduct the whole thing, set up the HRA, or it's got to exceed that threshold that I mentioned.
Okay. We'll answer 4 more questions and then we'll wrap up. This one says, is there a tax deduction even if all my real estate deductions are less than the standard deduction of $26,100?
Is there a tax deduction if my real estate deductions are less than the standard deduction? Let me give you a little. That's a really good question. A little structure of the tax code. You take your gross income, whatever you made. You subtract your real estate business deductions. You take all of those, whatever they are, and that includes the pass-through deduction, all retirement planning deduction, all those things. That gives you net taxable income. Well, that's it gives you net income. From that, you subtract your standard deduction, and that gives you net income, or tax. They call it taxable income. That's what you pay tax on. So essentially, you get all your business deductions plus the standard deduction. You get both. Get them both. Okay?
All right. This next question says, can we deduct home office remodeling?
Home office remodeling would generally be, it depends on type of remodeling. If it's just fix up type stuff, painting and maintenance type stuff, yes, the answer is yes. If it's improvements, like you're putting on a whole new wall, a whole new sink, a whole new desk, a whole new built-in desk, then you may have to depreciate it over 30. How many years was it? Commercial property, 30 and a half years. But if it's not something that's like built-ins, not something that's an improvement, then you can write off immediately. Generally, the rule is if it's under $2,500, you can take an immediate deduction for it. If it's over $2,500, if it's an improvement, then you have to depreciate it.
All right, referring back to writing off lunches, does this include catering?
Yes. If you're let's assume you're providing lunches for a group that you want to do business with, and you're catering the meal, yes, you can take a deduction as long as it came from a restaurant. Now the question is whether the caterer is qualified as a restaurant. If you're catering from, say, a Vons or Whole Foods or whatever supermarket you're dealing with, then it's 50% deductible. If you're catering from a restaurant, then it's 100% for a business reason.
Sandy, what about an actual standalone catering company? Because I actually own a catering company that I would hire my husband for. So would it be? We're not associated.
That's a
with
really interesting question. I don't know the answer. I don't know whether that comes under the term restaurant or under the term other company. I don't have an answer for that. We need IRS regulations on that. We don't know. All right. At the very least, it'll be 50% deductible. At the very least. Okay. Whether it comes within the restaurant purview, I don't know whether you get 100% for that. I don't know the answer for that.
All right. And then final question.
I would tend to think it comes within the restaurant purview, but I don't know the answer.
All right. Final question before we wrap up says, what if both myself and my wife utilize the home office? We can only deduct that once if we file jointly, correct?
Okay. There's a very important case with a home office called Hammaker. I want to share with you this case, something that everybody needs to know. A husband and wife work together in a room. Very nice togetherness. Isn't that nice? The husband claimed the home office because he used his home as his principal place of business. The wife did not. Because the wife did not use the room, it was right next to the home, wasn't necessarily separated from where the husband was. They were kind of right next to each other. Because the wife's use was not qualified for the home office, the case held that they killed the deduction for the husband. So if there's a husband and wife, you want to make sure that the husband is in a separate, identifiable area, unless the wife can show that she's using the home office as her principal place of business. But if she can't, then it's got to be a separate, identifiable area, separated from each other in order to claim the home office deduction. If it's too close, it's not separate, and one doesn't qualify, you'll kill that deduction for the other person. It's called Hammaker. It's a really, not a well-known case, but it's a real trap for the home office.
Sandy, I'm just going to ask you one more question just because it's COVID related, and then I promise we'll wrap up. It says, for real estate office staff who has been working from home during COVID, do they qualify for a home office in 2020?
If they are employees, the answer is no. If they are self-employed individuals, the answer is yes.
All right. Well, thank you so much, Sandy. I'm sure this was very informative for everyone. I would like to remind everyone that this recording will be available on the AAR webinar page next week, or hopefully ending of this week, if not next week. I will also send everyone a link to the recording, so you will have that in your email. Once again, thank you for spending a portion of your afternoon with us. And then thank you again, Sandy, for spending time with us.
My pleasure.